Our last bonus episode is savings to investing, and I'm excited about this topic. So there's sometimes a misconception. And that misconception is that if you're saving and saving and saving, that you've done all that you need to do financially. But the simple truth is that you're losing out on money if you only save that money and not invest. You need to always think about inflation. And I think we've talked about inflation a ton earlier. So say you save $10,000 a year for 10 years. You'll have $100,000. Your neighbor saves $10,000 a year for 10 years and puts that savings into investments. They have $144,000 or $145,000 a year. And just think about this. This isn't even taking into account inflation, right? So that $100,000 you have in 10 years isn't even worth $100,000. Neither is that $145,000, but it's worth a heck of a lot more than $100,000. And so let's just go into the investment calculator so you can get a crystal clear picture of this. And I encourage you to use this calculator all the time. I use this calculator like once a week, honestly. I just am curious about investments and how they could grow. I'm obsessive, but you need to use this calculator because it gets into your mind. Like when you actually can see the numbers for yourself, it changes your perspective about things. So say I have an investment goal. What investment goal can I have? Let's keep it simple. Let's keep it simple at $100,000. We'll keep it simple. We'll have, no, didn't add another zero. And we'll give ourselves 10 years to do it. The amount of initial investment, well, we don't need to initially invest anything. The rate of return they have at 8%, let's say that's a good rate of return, especially when we think about the fact that we have historically seen a 10% return on our S&P 500 index fund. So this is nice because in some senses we can say, well, this is actually after inflation. So maybe when I did this calculation before, it's actually after inflation. We're going to contribute $10,000 per year. We're going to compound that annually. I like to do compound annually normally because it's kind of normally what happens. It compounds annually every year rather than daily. Okay, let's see. Oh, that's where we got these numbers from, $145,000. Oh, wait, okay, actually, I stand corrected. You know, if you invested into an S&P 500 index, that 8% could be true after inflation, and you would have $145,000. Oh my gosh. Let's be more bold. $100,000 in 10 years? We can do better than that. Because what, 10,000 divided by 12? It's less than $1,000 a month. We can do more. Let's say, let's up our goal to 500,000. Let's up our goal. We need to up our goal. What is it going to take for us to get to $500,000 in 10 years? Is it going to take $20,000 a year? Is it going to take us $40,000 a year? Oh, we exceeded our goal then. $35,000 a year? Oh, close. 33,000. This is what I do all the time, guys. So as you're watching me do this, this is my life. $34,000 a year? No, we need a little bit more. This is honestly what I do all the time. Oh, we're getting closer. I'm determined to get to it now. Okay, close enough, right? $34,500. Okay, let's say 35 grand. 35 grand a year. That seems crazy, but is it? Is that a crazy number for you? You know what I'm saying? Say you have a combined household income of $100,000. So say you have a spouse or something like that to make this easier. When you think about it, okay, you're going to have taxes and stuff like that. let's say you're taxed at 30%, so you're taking home $70,000. When you think about it, that's half. You have to save $35,000 a year. That's half of it to have $500,000 in 10 years. And you could say, whoa, like, that is half of, you know, what you're taking home after taxes, but plenty of people can live on $35,000 a year in some senses, right? So again, you need to understand your life, your lifestyle, but like look at these numbers, right? And this is in 10 years. Most of us are not necessarily trying to accumulate all this type of money in 10 years. A lot of us are fine, say, if we can accumulate a million. Is that enough zeros? If we can accumulate a million by the time we retire. So let's give ourselves 25 years. Oh, whoa. Okay. Oh my God. If we're contributing $35,000 a year for 25 years, that's going to be 2.5 million. And this is like after inflation in our minds, right? So just to get to a million, okay, let's go back to 20,000. Oh, let's go to 15,000. Oh my God. Oh my gosh. Oh my Lord. 14,000. Oh my God, we can still go to less. 13,000 isn't going to cut it, is it? Nope. I just love doing this. Cracks me up, honestly, how numbers work. Oh my God. It's like literally how little can I contribute so that I can get to a million? That's how I think, right? So $13,690. What is that? Let's like calculate that per month. 13,690 divided by 12 is literally $1,141 a month. Okay, yeah, that kind of sucks, but like to get $1 million in 25 years, that is the power of this compound interest. This compound interest is just like taking us to a beautiful place, you know? I think it's just a beautiful place because if you think about it, if we contributed 13,690 a year for 25 years, we only contributed $342,000. So basically, we only contributed out of our own pocket. Ooh, sorry, that might have echoed. Out of our own pocket, a third of the $1 million. 2/3 of that $1 million is coming from like magic almost, you know? That's why they call compound interest magic. Like that is insane. And we need to take advantage of it. So, now that we know that we should invest, I think I've hammered in that point. What can we invest in, you might ask? So, some of these we've already talked about in our net worth section, in our assets talk, but let's like kind of get a refresher. So, certificates of deposit. So, that is basically when you can deposit money in a bank and get a higher interest rate than, say, our high yield savings account that we see at the bottom here. Well, high yield savings account, you can get a decent amount of money too, actually, a decent interest rate. I'm actually thinking about your regular bank account where you have like a very, very low interest rate. So you'll have a higher interest rate than your like regular old savings account at your bank. All you have to do is put that money in the bank for a specified period of time. So that could be 6 months, a year, 2 years, 5 years, whatever. And you get a higher interest rate for that. But like the thing is like the money is like it's virtually risk free. Like you have no risk in it. You're just going to get that like 2.5%, 2.4%, 2.1%, whatever that CD they call it, whatever that CD's interest rate is. So next is a money market account. So a money market account or a money market deposit account is a deposit account that pays interest based on a current interest rates in the money markets, right? So you're just going to receive the interest rate that the money market has currently. Next is Treasury securities. So Treasury securities are government debt instruments by the United States Department of the Treasury. And so basically they're just like telling you, okay, buy our debt so we can finance government spending as an alternative to taxing everyone. So they often just call Treasury securities treasuries. And that is a very safe investment because we trust the American government in this way. So U.S. government bond funds are mutual funds that usually invest in treasuries that we just talked about, treasury bills, notes, securities issued by government agencies. So they are considered to be the safest in the bond fund category and are ideal options for the risk-averse investor. So compare that to municipal bonds or municipal bond funds. Municipal bonds are debt securities issued by a state, a municipality, a county, or a special purpose district, such as a public school or an airport. So they're getting you to buy their bonds so that they can finance their capital expenditures. So I love municipal bond funds, and I'll tell you why. So municipal, when it says funds, it's kind of a collection of all these bonds, right? So there's more than kind of like one bond. So it's a fund, it's a collection. I love municipal bonds, municipal bond funds in particular, because they are exempt from federal tax and they may also be exempt from state tax. So it's a beautiful tax advantaged investment. So next is short-term corporate bond funds. So similarly like the government, a lot of the times companies need to raise money so that they can pay for, the lights, right? Paying for our salaries. And so they will issue debt out and it'll be for a short period of time, right? And so there's different ratings levels of corporate bonds, right? When we think about a company that is going bankrupt, their bond rating is not going to be very high. Like, for example, Forever 21, seeking bankruptcy relief, their bond ratings are probably going to be pretty low. And so you're not necessarily going to want to buy a bond in Forever 21. But say there's a safer company, say like a Google, you might want to buy bonds in there. But typically you should just buy it in funds because in a lot of ways, us average Joes don't have access to these huge companies, corporate bond funds, because they're raising like, $1 billion in debt, right? So they're not going to let us get like, $100 piece of that or $1,000 piece of that, or even maybe $100,000 piece in that. Those are huge deals, but you can join a fund so you can have a collection. It'll be a more diversified risk portfolio of corporate bonds. So next is dividend paying stocks, people's favorites, For example, you buy a stock in JP Morgan. So that's saying, okay, you have ownership in the company. It might be 0.00001% of ownership in the company because you might have bought whatever, $10 of it or $50 of it, but you still have ownership in the company. And so they will pay out dividends. And so whatever, you might get $5 here, $5 there. But, that's like a really small example, but on a big level, if you hold a lot of stocks, those dividends can be amazing. And if they're paying them out, say, monthly, whoop, yep, awesome. And then you could take those dividends and reinvest it back into that company. Just reinvest it back in JP Morgan. And so now, instead of owning 0.00001%, you might own 0.0001%. I think I got that right. So it's great because you can use the money that they're giving you to reinvest back into the company and then have a higher ownership and then in the future have higher dividends, right? And it's not just like, you don't just get the dividends too, you also like get the gains in the stock too. So if the JP Morgan stock, I don't know what the JP Morgan stock is right now, but if it goes to 40 to 50, That's an increase by 25%. The stock price increased by 25%. Your holdings increased by 25%. And you also get dividends. Yes. High yield savings accounts are similar to certificates of deposit. It's just that you don't have to keep it into the bank for a specified period of time, right? It's just a high yield savings account, right? There might be like a clause where you have to have a minimum amount in your account to keep it there. So they might say, oh, you need to have $500 at least or whatever. But it's a really great place to put your money if you want a higher rate of return than putting it in that regular old savings account that you have without really any risk, right? There's no risk to it. So obviously, depending on the company, you need to have a reputable bank, but there's no risk to it. Why wouldn't you just put it in a high yield savings account? Next is growth stocks and then stock funds. So growth stocks are stocks that are growing at a significant rate compared to the average stock in the market, right? So a fund is just a group of those types of stocks. And you can find a group of growth stocks by just looking at stocks that have a return on equity that is higher than you're seeing with other people. So that means that, okay, equity is, like, think about it, equity in your home. So that means equity in their company, compare it in a similar way, where people are just giving them money and they expect them to return that money back to them. Well, they're actually like doing that, they're doing it at a high rate. They're returning the money back to the investors that invested in them at a really high rate. So that's what a growth stock is. Next is S&P 500 index fund, which I highly, highly, highly recommend. The S&P 500, like we talked about before, kind of follows like the top 500 stocks in America, right? Public, give or take. And so you're just following the market. You're following like the largest companies in this country, companies that are bigger than the GDP of, multiple first world countries, right? So I think it's a great way to passively just invest your money and not really think about it. You're just following the market. If the market has been growing by 10% over its lifetime since, I think, 1926, okay, I believe in history repeating itself. Okay, about 10%. That's looking good, right? If you're getting 8% after inflation every year, like, you're doing well. Next is REITs. We talked about that before as well. And REITs have about 12% return, so 10% after inflation. And so we talked about this before. You're more exposed to the whole entire real estate industry. You're not just having one rental property. We're going to talk about rental housing next, right? Well, let's just talk about it now. You're not exposed to just that one rental property. You're exposed to a plethora of real estate options. It could be residential, it could be commercial, healthcare, whatever. But rental housing is also amazing because if you build that expertise, the rate of return could be way higher than 12%, Even if you're getting a 15% rate of return, you're still significantly doing better than the REIT, right? So rental housing is also an object. Next is NASDAQ 100 Index Fund. And so NASDAQ is kind of like the S&P, right? But NASDAQ is only following 100 companies. And so those are companies that could be like Amazon, American Airlines. And so it's a similar thing. Why not follow these huge corporations? They are the economy at a certain point, you know what I'm saying? Like, they are the biggest contributors to this economy. And so let's just follow the economy at a certain point. Yes, investments will always go up and down. But on general, we know the rate of return is increasing year over year. On average. Next is industry-specific index funds. So that could be healthcare funds. That could be consumer goods, that could be energy, right? Funds, whatever. So that could be a really great way to expose yourself to various industries. Like if you really, really think that like the healthcare industry is increasing, you can invest in that, invest in a fund like that. So it's great for people that have that expertise in industries too, because you can use the expertise you have in your daily life. If you're already in the healthcare industry, it could be an easy way for you to naturally feel that like this is kind of a safe investment for me because I know that the healthcare industry is going to go up in the future because I'm in it and I see that opportunity. So use your own like experience in your career as knowledge to kind of help you out with investing. So next. So you're like, but really, like, what should I actually invest in? You gave me all of these options. You just explained all of this. It's a lot. Yes, it is. It is an overload for sure. So these are the ones that I've suggested that you really take a deeper look into and that I think are personally the best in terms of just like the risk profile as well as the simplicity. I'm all about like optimizing everything, but keeping it simple. So what I like is certificates of deposit. Because like I said before, I think it's a great way for you to keep your money in a savings account for something that you're already saving for. So if it's a huge purchase, like you're buying a home, buying a car, just keep that money in there and save it in there and you're going to get a higher interest rate. Treasury securities are super safe. And I can kind of go with the government bond funds too if you want to fund. But treasury securities are so safe. You're basically just buying stuff from, buying the debt of the government and they're going to pay it back to you. It's like risk free. It's literally in finance, we consider treasury securities risk free, like zero. Like the risk is zero. Municipal bond funds, I mean, this is like an amazing one, right? Because of the tax advantage. So not only are we getting kind of like the safety of the government, we're also getting this tax advantage. Cool, put that in a retirement account. But I prefer actually, as we saw before, to put the S&P 500 index fund and the REIT into the retirement funds because there's also the accounts, like a Roth is already tax advantaged in some senses. And so you can put those into that account and not get taxed at the rate that you would have if they weren't in there. And then rental housing. I think that like because we live in houses and because we see houses all the time, we kind of have a special connection to them, right? So some of us can do management of rental properties and do it well. And so because we just like have experience, we do DIY stuff, we fix up things in our houses, like we get the concept. So I do encourage you to look into rental housing because it is a skill set that you could be building all the time. You just don't like think about it, but you are. So where should you hold your investments? So like we talked about in earlier sections, the retirement accounts, you should hold it in a Roth IRA, Roth 401k, or you can even put it into a traditional IRA or a traditional 401k. Non-retirement accounts, which is like a standard brokerage account or a taxable brokerage account, that's how they'll be referred to. You can either have an individual or a joint, so depending on your relationship situation. Then there's the HSA, which is the health savings account, which we talked about before. Also, there's the education account, so the 529 savings plan. So if you're saving for your children going to college, this is a great plan to look into. And then also real estate, as we've talked about before. So I hope that like me bringing up taxes randomly has made you think like that you always need to think about taxes because taxes is such an important situation in terms of investing. So you want to always choose the investment account that has the most tax advantages. So, the one that has the most tax advantages is for sure the retirement account. And they created it that way so that The government created it that way so that, like, at the end of the day, when you're 65, you can actually have a lot of money left to live for, like, however long you're going to live. So once you've used up the advantages of those retirement accounts, then you're going to go to a less tax advantage account. So that'll be the non-retirement accounts that we talked about. And similarly, think about the investments themselves and see if they have tax advantages. So we talked about how the S&P 500 index fund has tax advantages in itself. The municipal bond funds, we've hammered on that. So when you go deeper into investing, it's not just the types of funds you're getting, right? Active or passive, right? It's not just the fact that you're picking stocks or bonds or real estate. It's also the fact that you need to kind of think about the tax situation, because maybe putting your money in some type of account would not give you the most money over time compared to another account.